Hi, this is Praneeth again with session 3 of absorption costing and marginal cost. Margin of safety. Margin of safety. Margin of safety is a measure of amount by which the sales may decrease before a company suffers a loss. This can be expressed as number of units or a percentage of sales. Here is a formula. Margin of safety is equal to budget sales level minus break-even sales level. Margin of safety equal to margin of safety by budget sales level into 100%. Here is a graphical presentation of the margin of safety, which is which we can see margin of safety is equal to total cost and sales revenue, total cost by revenue, sales units. Here is an example. The break-even sales level is at 5,000 units. The company sets the target profit at $18,000 and the budget sales level at 7,000 units. Here is a requirement for calculate the margin of safety in units and express it as a percentage of the budgeted sales revenue. Margin of safety is equal to budget sales level minus break-even sales level. 7,000 units minus 5,000 units equal to 2,000 units. Margin of safety. Margin of safety by budget level sales into 100% equal to 2000 by 7000 into 100% equal to 28.6%. The margin of safety indicates that the actual sales can fall by 2000 units or 28.6% from the budgeted level before losses are incurred. Change in components of break-even point. Example: selling price per unit $12, variable price per unit $3, fixed cost 45,000, current profit 18,000. If the selling price is raised from $12 to $13, the minimum volume of sales required to maintain the current profit will be fixed cost plus target profit by contribution to sales ratio, which is equal to example $45,000 plus $18,000 by $13 minus $3 equal to 6,300 units. If the fixed cost fall by $5,000 but the variable cost rise to $4 per unit, the minimum volume of sales required to maintain the current profit will be fixed cost plus target profit by contribution to sales ratio equal to $40,000 plus $18,000 by $12 minus $4, which will be equal to 7,250 units. Limitations of break-even point. Limitations of break-even point analysis. Break-even analysis assumes that fixed cost, variable cost, and sales revenue behave in linear manner. However, some overhead costs may be stepped in nature. The straight sales revenue line and total cost line tend to curve beyond certain level of production. It is assumed that all production is sold. The break-even chart does not take the changes in stock level into account. Break-even analysis can provide information for small and relatively simple companies that produce same product. It is not useful for the companies producer multiple products. Here is the end of the last session. Thank you very much.